Ladies and gentlemen, welcome to Destination Retirement with Robert Kuhn.
Time to get on board with Robert Kuhn from Kuhn Capital Partners. Retirement is a destination you've spent decades saving for. And what you do with those savings can make all the difference in the life you live once you get there. Income planning, wealth planning, tax planning. Destination Retirement with Robert Kuhn starts right now.
Welcome. My name is Robert Kuhn, president and founder of Kuhn Capital Partners. I want to thank everybody for joining us today. Kuhn Capital Partners is a fiduciary. We're independent. We are a registered investment advisory firm. And if you've listened to the show in the past, thank you. If you're catching it via podcast, thank you. Send it on to somebody that you believe will benefit from hearing the show. If you are listening outside of the Chicago area, if you can hear my voice, then we can absolutely work together. We work with individuals who want to be able to make money, have positive returns, even if and when the markets are down to a point. So if you've listened to the show, you know that is our area of focus. If you'd like to have a conversation with myself regarding financial planning, regarding stock option financing, 401k management, anything investment related, we would welcome that opportunity. Please give Paige a call, 630-492-1912, 630-492-1912. She will set up our initial consultation. We can do it in person. We can do it via Zoom. We could do it over the phone. It really does not matter to me. So again, 630-492-1912, especially in this market. We are talking to so many new investors that have listened to the show for an extended period of time, and for whatever reason, the market has made them nervous and they are reaching out. So for those individuals who are listening, who have done that recently, thank you. It is a pleasure. It is an honor to answer any questions that you do have. Let's see here. A lot to go over this week. Market volatility is here one day, gone the next. Again, if you've listened to the show, you know that we want to help reduce taxable income. We do have a dinner coming up in Naperville at Morton's. If you are in the Naperville area or surrounding area and you have a portfolio value of over $1 million, then this is something that you want to attend. We're going to talk about ways to greatly reduce your taxable income. 630-492-1912 if you'd like to attend. Get with Paige, and then you and I can have a conversation to make sure that it's going to be time well spent for you. We do work with investors of all sizes, but this dinner is particularly geared towards individual investors, not because of me, but those are the rules with the alternative investments, is that you have to have $1 million net worth exclusive of your house. We got a lot of calls last week on the banknotes, and most individuals are going to tell me that I don't do a good radio show. Most individuals and consultants and those that have so-called expertise are going to tell you and tell me you want to keep things very high level, very generic, very basic. Get the listener to pick up the phone and call you. That's not our end game. Our end game is education. If we do a lot of banknotes, and especially on the income side. We did have a lot of calls last week on the most recent JP Morgan note that we did. Again, I just want it to be very, very simple for you to understand. It is backed by the issuing bank. In this case, it was JP Morgan. This one priced at 12% annual. So as long as the indexes that note was tracking or is tracking are not down 30% from the date it was issued, you're going to get a 1% coupon payment. So a couple moving parts, but it is very, very basic. And so for those listeners out there who want some predictability, who are nervous with the market, who think the valuations can't continue to go up, albeit they can. I mean, our gut feel, as you know, is irrelevant. My gut feel, your gut feel, it truly, really doesn't matter. But we are seeing many listeners, many investors just in general that are reaching out and saying, you know what, the market has run so much that it may make sense to put it in something that has a little bit more predictability. Put it in something that has a predefined outcome. Put it in something, again, some of your money, that I know that I could get 12% annual, 1% a month, as long as the indexes that a note is tracking that was issued by one of the largest banks in the world, most credit-worthy banks in the world, the indexes weren't down 30%. So if you have any interest in that, we are picking up our pricing of these, so we're going to probably start to do them once a week. We do have just the volume that we do, the way that these work. Again, my job is to uncover everything for you, the listener, kind of take this, curtain of, financial advice and really break it down. The more volume that we commit to, the higher the coupon payment for the individual. And we are one of the few advisors that I know of, at least here in the Chicagoland area, that incorporates the banknotes to the level that we do for all of our clients. So that just simply means that you're going to get a higher yield or coupon payment for the same exact note than somebody else if they were to do it. But unfortunately, most don't. So if you want a level of protection and you want to make sure that you could realize some of these gains, or protect some of these gains rather, and know that you're comfortable with a 12% rate of return as long as the indexes don't drop 30%, then give us a call, 630-492-1912. I'll make sure that you get on the list, because it may not make sense for you today, but it could make sense for you in a month, 2 months, 3 months, a year or two, whatever that is. So 630-492-1912. Spend a minute and go over some things that I found this week, and I found them very, very kind of interesting. And if you just do a quick Google search of what worries investors, it always amazes me what comes up. And it always is just, it's totally different than what I would envision that would worry an investor. And maybe it's just because, I'm in the industry and this is really for the bulk of my adult life. This is the only thing that I've ever done. But if you just Google what keeps investors up at night or what worries investors, it's just so interesting. And I saw an article this week that talked about the 5 most popular investing mistakes of 2024. And I think it's easy to get emotional about money. Very easy, actually, to get emotional about money. I think when you look at kind of behavioral biases such as overconfidence, loss aversion, kind of bandwagoning, or jumping on or jumping off, I think that can really push investors into making investment decisions that undermine their efforts to reach their goals. And if we look at what, at least in my opinion, if you look at kind of, what the goal is of your investable assets, it generally is to make sure that whenever you stop working, that your lifestyle, doesn't change. And so, yes, people are getting emotional about money, especially in this market. And I think, it's especially true today in this market with certainly recent memories of, the pandemic or generationally high inflation, markets that, just go up and go down, not only in the equity markets, but also the bond markets. And we look at, what happened, 2008 wasn't all that long ago, and in 2018 and 2022. And so, recession fears, and we hear a lot about that, certainly, here recently, but, those events, all of those events have left a strong imprint on investor behavior. And I think it affects are a lot of times negative. They're not always popular or positive, rather. And I think when you look at what the job of an advisor is, and I think that, I know because I host the radio show, but that's the job, I think, of anyone who hosts a radio show, is to educate. It's not to guarantee, sell annuities or to sell, guaranteed lifetime income or sell, X, Y, and Z, even though that's the bulk of, what the radio shows are today is just really a kind of an infomercial of a pitch and wrapped up into, just kind of a half hour or 45 minutes or an hour of basically saying, I know what you need. I don't know anything about you, but I know what the answer is going to be. And that's just different. We're focused on helping our clients achieve their goals for their wealth. And wealth is relative. And you've heard me say it over and over again. What wealth is to one investor could be completely different to another investor. And so listeners to the radio show or the podcast, we don't want you to think that you don't have enough money ultimately to work with an advisor. There are certainly advisory firms out there that have minimums. And now the investment choices, the investments that we put together, based upon your asset size, they'll certainly be different. That's just the way it is. But our job and our passion is to help everybody. And whether you have $10 million of investable assets, or, $50 million sitting in a money market, or $15,000, to your name that is inside of your 401k, I think everybody needs help, and especially in this market. And it's something that we pride ourselves on. That's something that we're not going to change. Our job, I know, is to make sure that we are making the most amount of money for you with the least amount of risk. And if we boil down investing, investing 101, it really just comes down to lose less when the markets are down. But yet 99% of people listening today, they have no strategies in their portfolio that can protect, can even make money when the markets are down. So a couple things that, we continuously come up against just in my conversations, when we do dinners, when we do, the radio show, when I'm a guest speaker somewhere, cashing out when the markets get volatile. And volatility is a funny word. I think if you look at volatility, it just is a feature of investing. And I think, when you look at since 1980, the S&P 500 has suffered average intra-year pullbacks of 15% or more in 16 of the 44 years. That's just going to happen. And I think when you look at what drawdowns are, even if the market is down 15% or more, generally speaking, actually 75% of the time, or in 33 of those years, the market has ended with a full year positive return. So when you hear the advice to stay invested when the going gets tough, I think it's a cliche. I think that it certainly depends upon where you're at in your investing life. If you're 10 years to retirement, well, just riding the market up and down, that's probably not the best strategy. Just, sitting and taking it and having a buy and hold strategy where you never make any changes inside of the portfolio. You have to ask yourself, number one, why are you working with an advisor if that ultimately is your choice or if that is how you want your money managed? You can certainly do that on your own. So if you're in your 50s, that's a very dangerous strategy. If you're in your 60s, that's a very dangerous strategy. If you're in retirement, that's a very dangerous strategy. So I get it. I get that the data shows that it tends to pay off over the long run to stay invested. But you have to think about this. And we're coming up against a break, but I really want to hit this. And I'm going to probably talk more about this in the second segment. Volatility, can be your friend. And if we have a portfolio, the most overused phrases in investing are, diversification and asset allocation. And, what diversification is to you is totally different to the advisor. I promise you that. Diversification of how they are managing their own money is greatly, greatly different than probably how they're recommending that you manage your money. Because the average retail investor, and let's put retail investor as, somebody who has, a couple $1,000s to invest to maybe up to $5 million. So it's probably the bulk of the majority of people that are listening to the show. The only diversification that you have inside of your portfolio are going to be bonds. And bonds are supposed to be the great equalizer. When the equity markets are down, the bond market is, that bucket of your portfolio is ultimately supposed to mitigate a lot of that volatility and, even make money so you can lessen or mitigate that drawdown. But yet here we are in the worst 4-year drawdown in the bond market in history. So these are things that are very boring, but you have to ask yourself, if you're working with an advisor, why are they not making sure that you are including additional strategies that ultimately can do well when the markets are down? And again, that's, what we, obviously talk an awful lot about. So I would love to see a study of, how an advisor invests their clients' money and compare it to how they invest their personal money. And I am here to tell you, based just on experience, there is no report, that it's greatly, greatly different. So we're going to talk about timing the market after the break. We're going to talk about if it can be done. So if you'd like to have a quick conversation or a longer conversation about your investable assets, about your portfolio, your IRAs, 401ks, tax reduction, etc., please feel free to give Paige a call, 630-492-1912, 630-492-1912. Set some time up where we can have a conversation. More after the break.
Planning for retirement is kind of like planning for the trip of a lifetime. First, you save and plan every detail. Then comes the day you've looked forward to for so long. Preparation is the foundation for successful travel and retirement. At Kuhn Capital Partners, we believe that foundation is a financially secure and tax-efficient plan that seeks to protect your needs now while looking to the future. Reach out to Robert Kuhn at 630-492-1912 and visit our website, KuhnCP.com.
Welcome back. You're listening to Destination Retirement. My name is Robert Kuhn. I am the president and founder of Kuhn Capital Partners. We're a fiduciary. We're independent. Our focus is making sure that we bring to the table strategies that can deliver positive returns independent of the market. Yes, that means even if the market is down, those strategies exist. If you'd like to have a conversation with me about your individual situation, my team, please just give us a call. You can reach out to Paige. Paige will set that initial consultation up, 630-492-1912. If you are listening to the show outside of the Chicagoland area, which is where we are headquartered, rest assured that we can work with you. So we do run the show in multiple markets. We love that. We love getting just to see the United States. We do have a very, very diverse client base, not only just individuals in their situations, but geographically as well. So we're very blessed that we do have clients all over the United States. So 630-492-1912. Set some time up and we can have that initial consultation. So trying to time the market. That's a very, very interesting question. Can it be done? Absolutely, it can be done. Is it hard to scale it and create a practice, an advisory practice at mass where an advisor can do that for every single one of his clients? It's very, very challenging. Is it hard to do consistently over time? You bet it is. So I think in a perfect world, investors would simply always buy at the low and sell at the high. Clearly, that is the way to consistently maximize returns and minimize their losses. Now, that's in a perfect world. Very, very challenging to do that, especially with the way that financial advice is given today. Buy and hold, again, buy and hold is kind of buy and hope. The challenge of, picking out a bunch of investments and then never making any changes. Goodness, if people are still doing that, it's great for the advisor. It's great for their income, but it's going to be a challenge for you, and it's going to be a challenge for you long term. So, I think that many people think that you can time the market. I think if you look at what history shows us that the average investor is greatly underperforming the market, and I put that on the backs of the financial advice industry because they're almost guaranteeing that you're going to underperform the market just based upon how financial advice is given today. And again, everybody thinks they have the best advice, or else you wouldn't be working with the current advisor that you are working with. But it's a very, very high percentage of advisors. They're just tracking the market. They're tracking the market up, they're tracking the market down, and then you're paying a fee for that. So you're really going to just simply not beat the market just because of that fee. So when we look at investors and we look at what's the most cutting edge way to manage money, well, in the 80s and 90s, it was, we have to diversify. We have to own small cap, mid cap, large cap, international, emerging markets. We have to own growth. We have to own value. So we basically can't tell where the markets are going to go. So you have to own all of the asset classes. You have to own the good and you have to own the bad. And with, kind of where we're at with technology today, it's not new in any way, shape, or form, but you often hear us talk about momentum. And if you listen to, or if we have the opportunity to speak, you're going to know that we look at the world differently. We look at the world that the markets obviously go up, they go down, they can go sideways. I think when you craft a portfolio, you really need 4 distinctly different strategies that don't move in tandem, that the return characteristics, what drives the returns is different. It's not all the same. And so when we look at kind of diversification, we look at it in a whole different light than probably what you're looking at it for. So we want to make sure that we have protected growth. And when you look at protected growth, it could mean strategies that are principal protected and there is no possibility of loss. Now you're going to limit your returns there. One of the strategies that we're using in that space for some clients, the current cap, which is the current maximum gain that you could get, is tied to the S&P 500, and that's 11.5% currently as I sit here today. Annually, so there's a trade-off. So your worst year is 0, so you can't lose money. So whether the S&P is down 1 or 50, you're down 0. Well, the trade-off to that protection on the downside is that you're also capped on the upside, and that cap currently is 11.5%. Those strategies are attracting so much money. I've seen studies that it's a couple $100 billion to $300 billion a year. It's significant, and rightfully so. I mean, I think if you're in your 50s or your 60s or you're retired, there's a lot of peace and there's a lot of sleep at night factor to take some of your money and put it in a strategy that can't lose money. It's tied to the S&P, and you know that, again, it's predefined, so you know that your best gain currently, as I sit here today, is 11.5% annually. And then when you get that gain's locked in. You don't have to worry about playing that game of, making up for losses. And those strategies exist. So when we look at protected growth, that certainly is one of those buckets. We also like to use, like I said, the banknotes. And these are strategies that there is a possibility of, potentially, seeing some losses. Now, a lot has to happen for you to experience those losses. The most recent, as I mentioned in the first half or the first segment, was a banknote that was issued by J.P. Morgan. And again, these all have a QSIP. They all have a prospectus. I mean, you should always take a look at them. These are, I would just hope that goes without saying. But again, I'm just giving you some education here. That was a 12% banknote, and that paid 1% a month. So that paid a monthly coupon of 1%. Obviously, that's 12% a year. So as long as the indexes that note was tracking were not down 30% from issue, you got your 1% for that month. And so they simply looked at it every single month from the date of issue. If they're not down 30%, boom, you get paid your 1%. So when we look at protected growth is not, put it in a CD or don't invest it. I mean, we still want to earn yield. We still want to compound that money. Even though we call it protected, that second component is growth. So protected growth, it's predefined. We know the strategy, or we know the outcome. We know what could or could not happen before we invest. And that is something that appeals to a lot of individuals. Unfortunately, most advisors simply don't do those protected growth strategies. If you didn't grow up in the industry and the business doing and incorporating those strategies, generally speaking, an advisor is not going to do something mid to late career to make their lives harder. So we got protected growth. Then we have growth. And when you look at growth, it's really simple. We want to grow your assets. And I'm so tired of hearing people say you can't beat the market. You can't beat the market. You 100% can beat the market if you have the right strategy, if you have the right fee, if you have the right advisor. I do want to preface everything by saying any performance that I give on the radio, that's past performance. It's not indicative of future results. Hopefully that goes without saying. But you can outperform the market. We use a money manager that we have access to, that individuals don't have access to directly, that rank in the, at least in this form, rank in the top 5% of all money managers going back to 1995. They've outperformed the S&P 500 on average, if you look at it over that period of time, by about 2 to 2.5% a year. That is significant. May not sound like a lot, but you do that 10 years. 15 years, 20 years, 30 years. Think about this. Put $1 million invested in the S&P in 95. It's worth about 10 million-ish today. Put $1 million invested in this strategy. Today, it's almost $20 million. So yes, you can outperform the market, but you have to have an actively managed strategy. So much, I mean, obviously index funds are so popular today. Advisors love them. Wall Street loves them because they don't have to do anything. That's the reality. They don't need to do anything. And they just set it and forget it. And they can go on to the next client, go bring in more money, increase their income. But that ultimately, I think personally, long-term is to the detriment of you, the investor. So growth. So we've got protected growth. We've got growth. And yes, you can outperform the market. Then we have growth plus. We say and coined it growth plus. It's just a easier way to say aggressive. That's okay. We want to have some aggressive money. And again, the strategy that we're utilizing inside of our growth plus bucket, generally speaking, the minimums are going to be too high for you to go direct to the managers that we're using. So we have met certain criteria that those minimums are very, very low, and we can incorporate these strategies. And this strategy, since 2015, now they've been running money since 2000, this particular strategy, they opened up to individual investors in 2015. It's up around 650% versus the S&P at around 250%. So think about that. That is massive outperformance. But it goes back to kind of what I was talking about earlier, volatility. So if you put all of your money in that and the markets drop, you're probably freaking out. You're selling at the bottom, can't take it anymore. So we want to make sure that when we craft a portfolio that we have protected growth, we've got growth, and then we've got our growth plus bucket. And then lastly, which is the most overlooked area in my opinion of financial planning, is tax reduction strategies. If you're working with a big bank, if you're working with a big brokerage firm, you have almost no proactive tax strategies. They think that, a bank and the big brokerage firms, they put such handcuffs on their advisors as far as strategies that they can and can't offer. They think that proactive money management or tax management is tax loss harvesting, or matching rather, your losses with your gains. I would just think that would be done automatically. What we're talking about is strategies that can greatly reduce your taxable income. Last year, had you invested $100,000 in the energy strategy that we use, you reduced your active passive income, W-2, 1099, by almost $90,000. That is significant. Now, there's a lot that we have to go over. It may make sense for you. It may not make sense for you. So don't just think that because I say that it's an investment for everybody, because it's not. But when you look at portfolio construction, that is how we construct a portfolio. Protected growth, growth plus, and tax reduction. If you have any questions on that, give Paige a call, 630-492-1912, 630-492-1912. Chasing headlines instead of sticking to a plan. We're going to talk about that and unpack that after the break. Welcome back. You're listening to Robert Kuhn, president, founder of Kuhn Capital Partners, independent registered investment advisory firm. And yes, we are a fiduciary. We are located outside of the Chicagoland area in Naperville, Illinois, off of 59 and 88. So certainly our presence here in the Chicago market is significant. But if you are hearing the show, if you are listening to my voice and you like what I have to say, if it interests you in any way, understand that we run this show in multiple markets and we can absolutely work with you. So the best way to get on our calendar and have that initial consultation, whether it's in person, whether it's over Zoom, or whether it's just a simple phone call, you can give Paige a call, 630-492-1912, 630-492-1912. She'll set that time up and we can go over what you're doing. I can answer any questions that I can for you, and I'll share with you, if you're interested, what we're doing and how we're able to, and what strategies we include inside clients' portfolios that can generate positive returns in negative markets. Our belief is let the up markets take care of themselves. If we lose less when the markets go down, maybe they will never go down again. Maybe that's just the case. Maybe the market's just going to continue to go up for the next 3, 5, 7, 10, 15, 20 years. Maybe every stock is going to be like NVIDIA or like the Mag 7. Listen, if that's the case, we all win, and I would absolutely love that. However, it's hard to craft a portfolio based upon that happening. So we want strategies that can do well when the markets go down. So 630-492-1912. So chasing headlines instead of sticking to a plan. I heard a talk on that over the last week, and I found it very interesting. If we go back to 2021, it was kind of the meme stock madness, and it minted many, many millionaires, seemingly almost overnight. And what we started to see was kind of the fear of missing out, and that really drove, just troves and troves of investors into stocks such as GameStop, as they just, simply seemed to never, go down. They just continuously rocketed higher. And many of those stocks, unfortunately, started to lose money. And many people would think, well, they ultimately crashed in, weeks and months after a lot of those headlines. And then more recently, if you look at, many investors, certainly in 2023, they feared a recession because the markets just can't keep doing what they're doing. And well, the reality is it can. And I often tell people, my gut feel tells me that the markets have to correct. My gut feel is that certain stocks just can't continue to go up. But as I mention often, my gut feel is just irrelevant. It's about as irrelevant, and I say this respectfully, as your gut feel. And that's one of the reasons in our growth and our growth plus buckets of management that we bring to clients is that we rely so heavily on the computers, because the computers are just not emotional. The computers just simply don't care. They don't have feelings, and they just, you know what? You're just going to own a stock until it looks like the momentum is going the other way, and then you're going to go find where the rest of the money is flowing to. If you look at the momentum-based index, it has greatly outperformed the S&P 500, and that's one of the reasons that when people ask me, well, what do you think and where do you think the market's going to go? What assets do you think are sectors are going to do well? And to me, I just say I have no clue, but the computers do. The computers can identify things that the human eye, the best analysts, just simply can't. And you can, if you have the right strategy, if you have the right computing power, if you're working with the right money managers, they can follow where the money flow is going to. So go back to 2021, it was the meme stocks. Well, what makes a stock go up? Well, it's money coming in, right? Supply and demand. What makes a stock or an investment or anything for that matter lose money is, well, there's not as much money coming in. So what we have seen today, and this, again, these are not new strategies institutionally. They're not new strategies to your advisor. You look at some of the best money managers over time who consistently outperform the market, and it's all mathematical-based investing. Call it, algorithms, quants, whatever. It just takes the money out, or the emotion out of investing, and it just says, computers, go and do your job. So, when I hear, chasing the headlines instead of sticking to a plan, well, what's the plan? I mean, what is the plan? And, so many people in 2023 hit out in cash and hit out in bonds. And not only did they hit out in bonds, and unfortunately they probably lost a lot of money because a traditional advisor is still using bonds as a means of portfolio diversification. and as a means of hedging. And I guess the question that I have for you is, how has that worked out over the last 4 years? And unfortunately, I know the answer to that, and it's just disappointing. I'm disappointed. I don't think that you I put that on the advisor, and it's laziness. It's looking at their interest first. It's trying to do a business that is scalable so they can increase their income. It's not, doing what I think is right for the individual investor. And so many people, hit out last year and just missed just a huge run in the market. And, it's unfortunate. And if you look at what the market did last year, it did really, really well. You look at some of our growth plus strategies that we utilize. I mean, goodness, these returns, everybody should be very, very happy with it. So whether it's hype or hysteria, humans simply have a knack for fixating on near-term dynamics that might prompt emotional decisions, good or bad, that could derail their long-term goals. And making a plan is easy. But again, I want to kind of decompact what that is as well. They say sticking with the plan is harder, but I think what's the hardest thing is recognizing tendencies in investing and trying to identify the misgivings or deficiencies of financial advice that so-called advisors are bringing to the table. And so, yes, a plan is important. We always talk about a financial plan. We always talk about making sure that we have a plan. But I often like to say the plan's not worth the paper it's written on if you lose money, because there's such a deficiency in financial planning software as far as how they calculate average returns. You either have a linear approach where it's going to grow at 6%, 8%, 9%, whatever every single year, and we know that that's not the case. Or you have kind of Monte Carlo, simulated returns where it sounds really good, it makes you feel really good when an advisor says, "Listen, we took a look at 10,000 different random scenarios of market returns, and you have a probability of meeting your goals in retirement of 80% or 90%. Well, that also means that there's a 10% chance that doesn't happen. There's a 15% chance or 20% or whatever that probability analysis is. So while it may make you feel good, there's also that flip side to that what happens if that 15% or 10% or whatever it is happens? What's your contingency plan? So a plan is important, yes, but again, a plan I think has become kind of an excuse to ultimately, losing money long term. Now, there are certain strategies, like we have an opportunity fund. And you know what? Man, the asset classes that we're in right now, it has been a beating over the last really the last year. Now, that's not a huge bucket of everybody's money. And it's in most instances, most people don't have any exposure to it. But you have to, so yes, you have to stick with the plan, but we have to make sure that there is a contingency plan in place. And I think the best question is to ask an advisor is, show me inside of my portfolio what strategies that I have in place that will either A, not lose money, so will protect principal if the markets go down, or make money if the markets go down. That's probably the greatest question that you could ask an advisor. If you're working with an advisor today, now is the time with where the market is that you want to ask that question. If you're managing the money on your own, then you got to look in the mirror and you have to ask yourself that question. Show me. Don't just talk about it. Show me. I want to see it. Is it 10%? Is it 50%? Is it 80%? Is it 30%? What is it? Show me the bucket of money, the allocation that I have that will preserve principal or not lose money if the markets go down, or even make money if the markets also go down. If that question can't be answered, then you are just riding the market up and down. And that's a real dangerous game to play, especially in this market. So 630-492-1912, 630-492-1912. If you have any investment-related questions, please just reach out to Paige, and she'll set some time up for us to have a conversation. Risk. I think risk is a funny word. And, you look at risk and you talk about risk, and, you talk about, what your risk tolerance is, and I still don't know what a moderate conservative investor is. But again, my job is to unpack what the industry is doing, what the advisor community is doing, and really try to share with you the limitations of ultimately, what that is and why it's going to limit ultimately your long-term growth and probably the ability to protect principal when the markets go down. So when you meet with an advisor, oftentimes they will ask you to fill out a risk tolerance questionnaire, 10 questions, and that is supposed to give you it's going to kind of classify what you are as an investor. Think about that. 10 questions. I mean, some are 8, some are 12, but on average, you're going to have 10 questions. And all of a sudden, you're an aggressive investor, or you're a conservative investor, or you're a moderately conservative growth value hypothetical investor. I don't even know what any of this stuff means, to be honest. What you look at when you're investing, and my youngest is 11 years old, and she has plenty of time before she would need access to funds, obviously. So does that mean that it's okay for her to lose money unnecessarily? But if you lose money, isn't that just more gains that you have to achieve to get back to where you once were? So I don't know what, these risk tolerance questionnaires, are there for. I mean, I guess we do them. I mean, I'm not going to say that we don't do them because you have to do them in today's day and age, but we don't put a whole lot of stock in them, and we just kind of really just use that as a conversation starter to really uncover, kind of what your thoughts are on risk and how you look at losses and how you look at volatility. And I think the investor today, when there's risk, you should be the most conservative investor in the world. When there's opportunity, I think you need to be absolutely super, super aggressive. And now, does that mean we do that with all of our money? Well, of course not. And I think when it comes to your money, you have to really think, what does risk mean to you? Clearly, it might bring to mind geopolitical conflicts. It might bring to mind bankruptcies, supply chain snarls, or asset bubbles, or markets going up or down. But do you also think of risks of such as outliving your money, or losing purchasing power due to inflation, or not having enough liquidity on hand to address unforeseen circumstances? So many individuals that we have talked with that have, really they're just exchanging one risk for another. CDs, right? I mean, goodness, we just won't go down that rabbit hole, or else we're up against a break here, and I don't want to go down that rabbit hole. But if you put your money in something that's earning 4.5-5% a year, that you look at, yes, you did take market risk off the table, but you just brought in longevity risk and inflation risk, because your rate of return after taxes and inflation, is it positive or is it negative? So when we look at risk, I think every investment decision comes with trade-offs. And we're going to talk about that more after the break. So 630-492-1912. Please give Paige a call, 630-492-1912, if we can answer any questions that you have regarding your investment situation. More after the break.
Planning for retirement is kind of like planning for the trip of a lifetime. First, you save and plan every detail. Then comes the day you've looked forward to for so long. Preparation is the foundation for successful travel and retirement. At Kuhn Capital Partners, we believe that foundation is a financially secure and tax-efficient plan that seeks to protect your needs now while looking to the future. Reach out to Robert Kuhn at 630-492-1912 and visit our website, KuhnCP.com.
Welcome back. You're listening to Destination Retirement. My name is Robert Kuhn. I am the president and founder of Kuhn Capital Partners. We're independent. We're a registered investment advisory firm. And yes, we are a fiduciary. If you can hear my voice, we can work with you. We are headquartered in Chicago, just outside of Chicago in Naperville. So obviously here in the Chicago market, we do a tremendous amount of business, but we are blessed to have clients all over the country. So we do run this radio show in multiple markets. So if you're hearing my voice and something I say piques an interest, please reach out to us, 630-492-1912. Get on my calendar. Let's have an initial consultation. It doesn't cost you anything. If anything, it's just a little bit of your time, and we're going to share with you kind of what we're doing, and we're going to do everything we can to answer your questions. If you've listened to the show for any length of time, you know that our focus is always crafting a portfolio that has the ability for some of the money to preserve principal in down markets, to make money in down markets, and those strategies exist. If you've listened, why am I saying that so much today? If you've listened to the show, it's driving me crazy. I can only imagine it's driving you crazy. But the bank notes, again, we do a lot of bank notes, and those are very reassuring notes and strategies for many individuals. There are a lot of individuals that are in their 50s, 60s, 70s, 80s that would take that trade-off of knowing the last one we did. Again, past performance is not indicative of future results. We have to look at prospectuses. We have to look at risk disclosures and everything like that. So those are very important parts of investing. But the note paid 12% annual. It paid 1% a month as long as the indexes it tracks were not down 30%. So we call that an income bank note. There is a legal name, but it's so long and you're going to forget it anyways. If you have an interest in it, just say, hey, I want to learn more about that income bank note, and we'll talk about those and what they are. So 630-492-1912. So risk. I think as you look at kind of investing, right? Every asset allocation, every investment decision comes with trade-offs. For example, and we talked a little bit about this here last segment, cash. It may satisfy your wishes to avoid losses during market drawdowns, but what has that done after taxes and after inflation? Well, I mean, that's a challenge. I mean, that is just a challenge. So are you just exchanging one risk for another? And that's something that when we talk about investing trade-offs, so there's a pro and con to everything. One of the things that we pride ourselves on, and we do hear this over and over and over again, and that is something that I'm very, very proud of, is that people will say, you did a very good job of taking a complex strategy, because this is something that investors don't do every day, day in and day out, and you've given me the basic knowledge to make a good, educated decision on if this is best for me and my situation. So if you talk with us, we're always going to tell you, here is the good, here is the perceived negative, here are the drawbacks that we perceive, and then if we can craft a portfolio that can meet your goals and objectives, and we know every single, well, I guess it's impossible to know every single outcome, but if we can go over the pros and we can go over the cons, then we pride ourselves on somebody not coming back to us 6 months, 12 months, 18 months, 24 months down the road and saying, you know what, you didn't talk to us about that. And there's nothing more evident than these guaranteed lifetime annuities. And I know we talk about it a lot on the radio. I know a lot of listeners have guaranteed lifetime income annuities, and I just don't think they fully grasp what they are. And again, you can't say we're against annuities. We think one of the best annuities out there is this very short-term 5-year strategy that is what we consider as a growth annuity. Doesn't have a fee. Your worst year is 0. You're capped at the first 11.5% of the S&P 500. That's what the current cap is. So you can't say we're against annuities. There are so many people listening that if they know that the only trade-off to not losing money in a single year ever is to having a maximum gain of 11.5%, which it currently is, and it's tied to the S&P, many people will jump on that in a second. So you can't say we're against annuities, but these lifetime income annuities, you have to think about. Now, is there a place for them? Well, of course there's a place for them. In my opinion, it's for somebody who has a couple $100,000 and they've got 5 years, 7 years, 10 years till they need that income. Then it might make some sense. But again, we have to look at it. But they're oversold, in my opinion. They pay a big commission. They're the sleep at night factor of knowing that you can't outlive income. Listen, that is very, very appealing. It's not lost on me that is very, very appealing. But you have to dive just a little bit deeper. you are only taking your own money out of that annuity until the account goes to zero. When the account goes to zero, then the insurance companies are going to pay you from their funds. Think about it. Do the companies know actuarially, statistically, that that's not going to happen almost all times? I mean, the way that they hedge that is they give you just a little bit enough growth, but they limit your distribution. They limit how much you can take out. So don't, again, it goes back to that risk, right? Yes, I get the guaranteed lifetime income as a really, really nice sleep at night factor, but you're almost just ensuring that you're going to just deplete that asset to something significantly lower than what it is today, because the growth on these strategies, generally speaking, has been so pathetically low. So why not take a look at more of a growth annuity? Why not take a look at a very short-term strategy that doesn't have to hedge for lifetime income? And so it can be tied to an equity index like the S&P 500. And again, there are so many people listening today that if you knew that your worst year was zero for some of your money, some people would put all of it in, which is, we don't think obviously makes any sense. But again, it's not my money. But if you knew that your worst year was zero, and the only trade-off to that was the cap is currently 11.5% of the S&P. So you got from 0 to 11.5% of the S&P 500, you received 100% of that return. There's a lot of people that want to know that strategy, learn a little bit more about that strategy. And we look at that strategy as an alternative to guaranteed lifetime income. We look at that strategy as an alternative to bonds. We look at that strategy as an alternative to CDs. So if that's something that piques an interest, again, it's something that we should have a conversation about. 630-492-1912, and you can just say principal protection strategy when you call Paige, and I'll know kind of what more you want to learn about. So as we finish up the show today, the markets are what the markets are. And, valuations are high. In many instances, valuations are extreme. We didn't talk a whole lot about Mag 7 or Mag 10, the 7 stocks or the 10 stocks that are driving the market today. We are going into, obviously, an election, inflation. I guess the Fed wants to cut rates in September. I think it's, if they think inflation is coming down, my insurance bill, my energy bill, my food bill, they just absolutely disagree. But if they do cut rates, it's going to be interesting, because I've seen there's many, many studies out there that show when they start to cut rates after a run that we've had, that the markets drop, and it drops significantly. And everything generally reverts back to the mean in pretty much all areas of life, but certainly here in the stock market. And so, I just want you as the listener to think, the markets have run. What are you going to do to realize those gains? What are you going to do to make sure that you don't give those gains back? And if you can't answer that question, if you can't look at your portfolio, if you can't ask your advisor, show me what you have in my portfolio that will protect these gains, that will protect my principal, or even make money when the markets are down, you just owe it to yourself to have a conversation with somebody new. If you're managing money on your own, then you know what? The buck stops with you. Ultimately, you are the decision maker. You need to look in the mirror, and you need to ask yourself that question. Many, many of our clients obviously come from, other advisors, of course. I mean, that goes without saying. But here recently, in the last handful of months, we have most of the new clients that we've brought on board, each week. They're from do-it-yourselfers. They're from they've been managing money on their own, and they just are not confident that they have the strategies in place that can weather, a down market, or can weather, a period of time of significant uncertainty. So while nobody's immune from investing mistakes, we have to minimize the missteps. And I think that is one of the things that we're very competent on, that we're very focused on, is trying to get through to individuals that now, when the market is up where it's at, it's not what has happened. We have to look at 3 years, 5 years, 7 years from today. For those people who don't think that the markets can stay flat to down for an extended period of time, just do some simple research. Pull up Microsoft. Look at, had you bought Microsoft in 2000, look how long it took you to get back to even. 12 years. Just to back to even. So, the markets can stay down longer than most people can handle a situation of stress in the market. So, again, our unique value prop is making sure that we are bringing strategies to the table that can protect principal or even make money when the markets are down. You know that we're big believers of the banknotes. If you want to get on our distribution list, because we do, they may not be, readily, or they may not, be of interest to you today. They could be tomorrow. They could be in 6 months. They could be in a year or two. And it's so amazing when we talk with individuals who reach out, who say, you know what, I've listened to you for so long, I just finally had to reach out. And to those investors that do that and take that, just kind of that leap of faith to reach out to somebody that you don't personally know, but you've heard on the radio over an extended period of time, I want to say thank you. It's just very reassuring that our message is getting through. So with that said, I hope everybody has a great week. We're here to help. 630-492-1912, 630-492-1912. More next week.
This recording is for informational purposes only and should not be considered investment advice. Kuhn Capital Partners does not provide legal, accounting, or tax advice. Any statement regarding such matters is explanatory and may not be relied upon as definitive advice. Opinions expressed are current as of the date of this recording, and such opinions are subject to change. The views and opinions of guests on this program are not necessarily those of Kuhn Capital Partners. Any reference to guarantees, principal or income, protection, buffers, or defined outcome investments are generally structured notes or fixed insurance products backed by the claims-paying ability of the offering company and are not insured by any government agency. Kuhn Capital Partners is not affiliated with any guests unless otherwise stated and does not guarantee the accuracy or the completeness of any data presented. Kuhn Capital as of the date of this recording, and such opinions are subject to change. The views and opinions of guests on this program are not necessarily those of Kuhn Capital Partners. Any reference to guarantees, principal or income, protection, buffers, or defined outcome investments are generally structured notes or fixed insurance products backed by the claims-paying ability of the offering company and are not insured by any government agency. Kuhn Capital Partners is not affiliated with any guest unless otherwise stated and does not guarantee the accuracy or the completeness of any data presented. Kuhn Capital Partners and its affiliates are not responsible for any trading decisions, damages, or other losses resulting from or related to the information, data analysis, or opinions in this recording. Past performance is not a guarantee of future results. All investments are subject to investment risk, including but not limited to the potential loss of principal. Advisory services are offered through Kuhn Capital Partners, LLC, a registered investment advisor.